When news breaks that a second carrier strike group is being deployed, most people instinctively think in terms of military escalation ships, aircraft, strategy, and the possibility of conflict. But what's happening in that moment is bigger than a simple defense maneuver. It's a signal, and signals, especially when they come from institutions as visible as the United States Navy, ripple through global psychology long before anything physical happens. Markets don't wait for outcomes. They react to perception. That's exactly why today's silver crash isn't just a commodity story. It's a live demonstration of how fear, uncertainty, and financial structure collide in real time. Think about how modern markets are wired. They operate on speed, leverage, and expectation. The moment headlines suggest elevated geopolitical tension, risk models begin recalculating probabilities. Algorithms scan language for escalation cues. Institutional desks reassess exposure. And suddenly, what looks like a calm trading session becomes a scramble for liquidity. Silver, despite its reputation as a safe haven metal, sits at a crossroads between industrial demand and speculative positioning. That makes it particularly vulnerable during moments when traders aren't making philosophical decisions. They're making survival decisions. When tension rises, the first instinct for leveraged participants is not to accumulate safety. It's to protect capital. Margin requirements tighten. Brokers demand additional collateral. Positions that were comfortable hours earlier become liabilities. In that environment, traders sell what they can, not necessarily what they want. Silver futures and ETFs are liquid accessible and widely held, which means they become a convenient source of cash. The selling pressure isn't a vote against silver's long-term value. It's a mechanical consequence of how leveraged finance operates under stress. Now layer psychology on top of mechanics. Headlines about military deployments activate a primal response: uncertainty. Even seasoned investors aren't immune to the human instinct to de-risk when the future suddenly feels less predictable. A carrier deployment doesn't guarantee conflict, but it raises the perceived probability of disruption to shipping routes, energy markets, diplomatic relations, and economic stability. The brain doesn't differentiate cleanly between risk scenarios. It simply recognizes elevated danger and pushes toward caution. Multiply that reaction across millions of participants, and you get synchronized selling behavior that feeds on itself. What's fascinating is how quickly narratives form after the price move. People start asking, why is silver falling if uncertainty is rising? On the surface, it seems contradictory. Historically, precious metals are framed as protection against turmoil. But real markets don't move on textbook definitions. They move on positioning. If silver is crowded with speculative longs when fear spikes, the path of least resistance is downward, at least temporarily. Urgency wins in the short term. There's also a structural layer involving cross-asset correlations. When geopolitical stress appears, energy markets may surge, bond yields may fluctuate, currencies can swing, and equity volatility spikes. Large portfolios rebalance dynamically to maintain risk targets. That rebalancing often involves selling assets that have appreciated recently or carry higher volatility metrics. Silver frequently falls into that category. So, the drop you're seeing isn't isolated. It's part of a multi-asset adjustment cascade that prioritizes stability over conviction. Behind the scenes, because it implies potential fiscal, logistical, and diplomatic consequences. Actions coordinated through institutions like the United States Department of Defense don't just influence military analysts, they feed directly into macroeconomic forecasting. Traders begin pricing in scenarios: higher energy costs, supply, chain friction, currency hedging, and capital flight patterns. Those expectations shift liquidity preferences almost instantly. The silver move you see today is happening in the uncertainty window, the period where information is incomplete and imagination fills the gaps. In that vacuum, risk premiums expand. Volatility. Participants who rely on tight spreads or short-term leverage step back. Liquidity thins, which amplifies. price swings, fundamentals don't vanish. Industrial demand for silver doesn't disappear because a carrier changes course. In moments of stress, time horizons collapse. Understanding that distinction is crucial because it prevents emotional interpretation of what is fundamentally a liquidity-driven event. There's also a reflexive element. Once silver begins falling, momentum traders pile in. News outlets amplify the move, which reinforces the perception that something significant is happening. That feedback loop accelerates price action beyond what the initial catalyst alone would justify, making the drop appear sudden and dramatic, when in reality it's the culmination of layered reactions. This moment reveals is how interconnected modern systems have become. Military posture influences sentiment. Sentiment influences leverage. Leverage influences liquidity. None of these components operate in isolation. A carrier deployment is not merely a defense decision. It's a psychological shockwave that travels through financial architecture at digital speed. Silver's reaction is one expression of that shockwave, a snapshot of how markets metabolize uncertainty. For the audience, the takeaway isn't to memorize every mechanism or predict every move, and those responses can temporarily overpower fundamentals. When you understand that chain, volatility becomes information instead of noise. Beneath the algorithms and balance sheets are fear, caution, and survival instincts. It moved because uncertainty forced participants to act faster than they could reflect. But in the heat of a geopolitical headline, liquidity speaks louder than logic. So when you watch silver drop alongside news of military escalation, you're witnessing a compressed lesson in how modern finance responds to uncertainty swift, and understanding that response transforms what looks like chaos into clarity.